In today's video, I wanted to talk about the Hammer CandleStick Pattern, one of the most popular price patterns that traders use to identify a bottom. A hammer occurs after a stock has been declining, suggesting the market is attempting to determine a bottom. This mostly occurs when a security trades significantly lower than its opening, but rallies within the period to close near opening price. What this essentially looks like is this. The pattern forms a hammer-shaped candlestick in which the lower shadow is at least twice the size of the real body. Let's break this down really quick. Here we have a very obvious example. We have a price decline in which there is a drawdown leading to a turbulent period in which we have our hammer. We can easily identify it by looking at its shadow, this long thin line that is well over 2 times the body, which is right here. In this case, the shadow looks to be about 4 times longer than the body, making it very obvious. At this point of the day, a trader could use this indication to enter a long trade because a hammer is a signal for a price reversal to the upside. One important thing to remember is that traders like to use confirmation signals to essentially confirm that this is indeed a true reversal signal. In our example here, the confirmation comes on the next candle, which gapped higher and saw the price get bid up to a close well above the closing price of the hammer itself. Quick side note here as we talk about the closing price of a candle, it's essentially the top or bottom of a body. A red candle will mean that the close price is at the bottom, and a green candle will mean that the close price comes at the top of the candle. In our example, the hammer close price is right here because it's a red candle. The confirmation comes as the close price of the next candle closes well above the closing price of the hammer. Traders typically wait until the confirmation candle to buy. A good strategy is to use a stop loss placed below the low of the hammer or even potentially just above the hammer's real body if the price is moving aggressively higher during the confirmation candle. This way you lock in profits but also limit your downside if the confirmation never comes. It's also important to note some of the limitations. Remember, there's no assurance the price will continue to move to the upside following the confirmation candle. A long shadowed hammer and a strong confirmation candle may push the price quite high within 2 periods or the next 2 candles. This might not always be a good place to buy, as the stop loss may be a great distance away from the entry. This is also why it's important to get in and out of the trade at the correct times, as I mentioned above. You need to exit using other types of candlestick patterns or analysis. Hammers don't provide a price target, so figuring out what the reward potential is can be quite difficult. There are many scenarios where the risk posed to the trader entering a position based on a hammer doesn't justify the potential reward. Do your research and investigate some exit points before entering. Thank you guys for watching. Please make sure you hit that subscribe button if you enjoyed and want to see more videos like this.